That's the only answer all of you should know. How do you make money in investing? You buy low. That's the simplest answer. So if you're contributing to your 401k and the market's going down, what are you naturally doing without doing anything else? You're buying low because you're dollar cost averaging into the market as the market goes down. This is a great strategy. All of you should be doing this right now. As the market sells off and continues to go down, you should be dollar cost averaging into it. If you like Bitcoin or Ethereum, because that ride is going to continue to probably go down with the markets, well, you should continue to buy it. Any money that you've got sitting in it, why in the world would you ever want to ride that roller coaster down with your 100 or 200 or 2 million or 20 million, whatever dollar amount you've got sitting in the markets right now? What's going on, everybody? It's another week, which means it's another wealth webinar. I've got some friends with me today. I got Jason and I got Joe, and today we're going to get into some serious things. That's right. We're going to start talking about some strategies and some tactical things you need to be doing right now with your money to get ready for this. Now, I know it seems cliche, and sometimes I feel like we're always talking about the same things, but you know what? Maybe we are. And maybe that's on purpose. Maybe you need to start hearing things more than once, because as you watch your 401k balance go down, and as you watch your brokerage account balance go down, and as you get on the phone with your trusted advisors and they say, just hold tight, it'll be fine, we're in this for the long haul, it's just a paper loss, you keep asking yourself, whoa, is this really what I should be doing? Well, today we're going to talk about whether that is or is not the right thing to do. And we're going to actually just do it with some math and some logic, because you know what? I think a lot of you, just like me, invest with emotions, right? You get excited about something, you emotionally get, fired up about something and you invest. Well, I used to do that. I used to invest almost 100% emotionally. Someone in the office would say, oh, you got to check this investment out. Or someone in an Uber would say, oh, did you hear about this thing, this FTX thing? You got to get on board with their FTT? Sure. It's coin, like whatever. Somebody gets you fired up. You make the investments emotionally because you're emotionally charged, and you just left logic in the Uber. Like logic just stayed in the Uber, your emotions and your smile just got out of the Uber. And then all of a sudden the Uber drove away and you opened your thing, and right there in the front of the news, FTX gone. Okay. But I guess they did find like $9 billion, right? Or something like that this morning. But somehow they just miraculously found a couple $1 billion or $1 million or whatever the heck it was. Doesn't matter. It's still not good. So today what we're going to do is we're going to dissect that, but we're going to also get into the mindset around why you haven't done it yet. Because I bet you, if I were to ask a lot of the people on here, have you made some changes in your brokerage account? Have you made changes in your 401k or your IRA? And well, here, let's try this. How many of you, and I want you all to be very honest with yourself, because if you're not honest with yourself, I don't know, that's a big problem, and we should have a sidebar conversation about that sometime. But what I want to know here real quick is, how many of you actually have taken a look at your 401k, your investments, and actually went in and did something, reallocated it, repositioned it, did something about it? In the chat right now, I want you to put I have, or just put I. Okay, well, not bad. That's actually way better than I thought. So obviously people are listening. Now, hold on, everybody that has, let's pause. Now this is where the honesty part comes in. Be honest with yourself. How many of you have not? So just put not in the chat right now. Really? Okay. Well, I'm starting to think there's no way. Okay. Took a hard look, end of 2020, started changes in 2023. Okay. So now can all of you that just said not or half or have not, can you just tell me just one reason why you haven't done anything yet? And you guys can do it. I just want to kind of see some of the comments. Why have you not made changes yet? Scared. Okay. Great answer. Going to see the damn advisor next week. I'll tell you exactly what he's going to say. Lack of insight. Great answer.
Stick with it.
I don't have a 401k. Hell, that's a really good answer.
Good one.
Lack of knowledge. Selling securities in a route to make them else kind of addicted to trading options. Okay. So James, trades options, and you can make money, when the market's going up, going down, or going sideways with options. So, okay, all good answers. But, a lot of them were lack of knowledge, scared, don't know what to do. Okay, and then somebody bought Bitcoin in 2015, which if you bought Bitcoin in 2015, the second question I got to ask, Nick, is, did you sell it? Come on, did you sell it? Because if you bought it in 15 and if you had sold it, I don't know, anywhere north of like 30,000, dude, like what island are you at? And can I come see you?
His own.
Just asking for a friend. But if you didn't sell it, you're sitting there saying, I shoulda, I coulda, I woulda, or you're playing the hope game. These are all mindset things, folks. These are all emotions. Everything you all just said was an emotionally charged answer, with the exception of like, I trade options. That's a logical answer. Somebody saying, you know, I'm meeting with my advisor. I guess that's logical if you got a trusted advisor.
You would have made more with the theory.
Made more with theory. No. Yeah. All right. So, but Nick, you didn't answer the question. Did you sell? No. Why didn't you sell? Sold a little. That's not a good answer. Why didn't you sell? You bought it in 2015. Anyone that understands the crypto world, and even my lazy cashier understands that. We all know what you paid for that holdings. Why didn't you sell? I have enough real estate. Excuses. Why didn't you sell? I don't mean to pick on you. I just want to know why you didn't sell. Hoped. There we go. Frank actually just answered it for you, Nick. You hoped it was going to go higher. I mean, you did. You hoped it was going to go higher. That is the only logical answer that somebody could give for why they wouldn't have sold. Or, you know, I was on my island and I just haven't been watching it, man. I made so much money, I just wasn't watching it. I'd say that's logical. So here's the deal. Let's just talk pure logic. And let's just get into the reason behind this. And then we're gonna then debunk this and we're gonna get into this. So, and then we're just gonna call this 2008. And this is not to scale, okay? This is kind of where we're at now. So logically, here's what we've got to look at. We got to go back in time. We got to go back in time and we just got to, because that's our only reference point. And just so you all know, this would be 2020, the pandemic. This was, you know, let's just put some things. It's about a 32% fall down to here. Right now, you're sitting at about, give or take, about a 20% drop. And during the pandemic, depending on where you got out, you know, 20, 30, 40, I mean, we can go down. It went lower than 50, but you all know this is kind of what the markets did. All right. But up here, everybody was cheering. Right here, everybody was cheering. Right there, everybody was cheering because your emotions were telling you that, oh my God, I'm doing so good, it's going to keep going up, right? So actually, Nick said, you're talking like it won't go back up though. I'm in this for the long haul. I pay attention to Bitcoin halving cycles. No, Nick, I'm not saying it's not going to go up. I own Bitcoin. I dollar cost average into it. I'm certainly not saying that, but I was simply trying to, I wasn't getting like, you're still making excuses as to why you didn't sell. Because if you sold, you still could have bought in when it went down, right? So if you sold it at 40,000, Nick, and I'm not trying to pick on you, man, I'm really not. I'm just trying to make a very strong point because I'm not disagreeing with anything you're saying, but they're all excuses. So if you had sold anywhere, 30, 40, 20, I mean, you bought in 15, wherever you would have sold, you would have made a nice profit. Yes, you would have paid taxes, which we're going to hit today. But if you sold, why couldn't you have bought back in when it went down to 14 not too long ago, or 15, or I think it's at 16 or 17 now? Why you could have just bought it all back? It's not like there's a shortage of Bitcoin out there. Okay, there's plenty of Bitcoin. It's not like cars where there's a shortage of chips or whatever the hell excuse they're making. So that's all I'm trying to say, Nick. I'm not picking on you, but this is really good, which is why I'm really hitting on you, because like you're just like everybody else. You know, like we make excuses in our mind as to why we don't do things, but if we just peeled that excuse, that emotion away, and we just logically look at it, if you had sold, all right, let's go here, 2008. Let's just take, we can only go backwards. So let's go backwards. In 2008, when you were down 20%, and some of you actually remember this, you started getting a little bit scared. So this is where, you know, you get scared. A lot of people that I asked why they haven't done something, they said they're scared. Well, we're right here, right? Everybody said we're scared. A bunch of people, that was the biggest answer, scared. But here, like there's cycles, emotional cycles that we will go through as the market sheds more off. If you got scared, and even if your advisor said, oh, we're in this for the long haul, you gotta, and I would have been your advisor back then because I was in that. Oh, we're in this for the long haul. It's just a paper loss. We got to hold out. We got to just ride this out. But let's just say you sold, okay? If you had sold here, 20%. The first thing I will tell you is, yes, you just locked in your loss. Great. You locked in your loss. And in that calendar year, guess what? If it's a loss not in a 401k, you get to write that off. That becomes a loss against your taxes. So not such a bad thing. In hindsight, how many of you wish you would have sold all of your stocks, mutual funds, 401ks in 2008 when you were at 20% down. So Raymond said he wouldn't have been happy if you sold at 20%. Whoa, okay, well, hold on. Maybe I didn't frame this up right. The market shed more than 50%, depending on what you were invested in, but you would have went down between 40 and 50% in 2008. If you only lost 20 and all your friends lost 40 or 50, would you have been happy you sold at 20? I guess that's a better frame up. Would you guys have been happy that you sold at 20 if all your friends lost? Okay, sorry, I guess I didn't frame that one up right. It was in my mind. I had it. I apologize. So here's why you would have been happy. Okay, it just comes down to this. Now, this is a chart. It's called the drawdown effect. It's a very real thing, and it's a mathematical equation. It's all this is. And for any of you that have been around the campfire for a little while, found it. You know that I do a lot of things and I solve a lot of things mathematically. So let's just do this really quick. If you got out at 20, yes, you locked in that loss. Yes, you could make excuses saying, oh, I got the tax write-off. I really needed it. Maybe you did, maybe you didn't. Maybe it's an excuse, emotional. But here's the thing. You would have only had to make back, okay, if you lost 20, you only need to make back 23% to get back 100% of what you lost. Not bad, right? You lose 20, you got to make 23% back. Or I'm sorry, not 23, 25. Okay, so you got 25. So 5%, that's why it's only fear, right? That's why this point's only fear. See, at 30%, there's something that kicks in, and this is called reality. Reality kicks in. At about 30%, you start realizing and seeing around what's going on. And usually at about 30 to 40, somewhere in that range, you know that the market's going to continue to sell off. You know people are going to start losing their jobs because people are already losing their jobs. You're seeing it in the news that companies are laying people off. They're freezing hiring, and people are definitely getting let go. Just so you all know, that's right now, just like it was back here. Reality sets in. So if you lose your job and you no longer have an income or you're just on unemployment and there's no other jobs out there because no companies are really hiring, you can get a job at Burger King always. But your job was a unique job. You made a couple $100,000. And you no longer can find work paying a couple $100,000. So you got a little bit of a predicament. But the second part of the reality is this. This is the pure math. If you lose 30%, you have to make 43% back just to get back the 30 that you lost. Pure mathematics. I'm not doing anything that's not just math. Okay, and some of you, this is a repeat. 40% is 67%, and 50% is 100. If you lost 30 or 20 and you sold, and you know you only got to make 25 back, you sold because you were scared. Are you happy now? You're ecstatic. You're thrilled because now we can look back in time and we can see what happened. And you would be like, I'm so glad I got out when it was 20. I wish I would have got up here. This is we all wish. I mean, we all wish we could always get out at the top and buy in at the bottom. And guess what? You'll never get that right. Ray Dalio can't even get that right. So don't you think you're going to get it right? Because you're not. So here's the math. 20, you got to make 25. 30, you got to make 43. 40, you got to make 67. 50, you got to make 100. How many advisors out there, they are going to tell you we're in this for the long haul, understand this? And when you pose that question after you meet with your advisor, how many of them are going to say, oh, don't you even worry, no problem. If we lose 40, I'm going to have them guarantee you that they're going to make you 67% back. How about that? All right, Mr. Advisor, I'm going to go with what you're saying, that we're in this for the long haul, but I need you on this piece of paper to write your name, all your information, and put a big guarantee. I guarantee I'll make you back 67%.
Ask them to put a lien on their house for you for that guarantee.
Whatever. I mean, I don't know. Call Joe. He'll help put a lien on it for you. Get one of those HELA loans. But anyway, like this, all I'm trying to explain to you, this is reality. But this is super easy for us to do because we're just going back in time. And going back in time is super easy because we got the whole picture. I could pull up a real chart and we can really look at what happened and we can remember those times. We can remember how long it took. But for any of the people in 2008, so now let's do another thing. So now we got all the math. Now let's go round 2. Okay, so now you wrote it out. Does anyone remember 2010, 11, 12? Any of you guys remember all those all the way up to the highs of 2020? You remember that period of time? Well, I can tell you people in 2008, when they remembered their high points. We always remember the highest point our value was. Just like Nick, he remembered the highest point that his Bitcoin balance got to. Okay, just all of us do. We always remember that high point. I know where mine is. Okay, I'm not there now, but I just own treasury bonds. But we all know that high point. That's the bar. And then we all can look and see where we're at, but we never really remember the low points because we try to erase that from our memory because we just don't want that memory. But if you remember the high point, just hear me out. Here's what the media does to us. So you lost, let's just do 30%. So remember, 30 requires you to make 43 back. So you lost 30 and you made 43. So you're watching the markets, and in the news, you hear some news channel say, finally, I think it was 2014, actually. So we got to kind of go over here. 2014, someone comes on and there's a news article. The markets have now exceeded the value of the highs of 2008 before the Great Recession. So we are above the old highs that we made in 2008. So now you're like, oh my gosh, well, the markets are higher than they used to be. And you're just thinking in your mind, emotionally, you want to look at your 401k statement, which has been down the entire time from 2008 to 2014, give or take. Okay, I might have the years off a little. You've been down from that high point the whole time. It's been steadily climbing, so you feel good about it. You're seeing green, but you're still not at that high point. So you're still like, oh, when are we going to get back where we were? It took that long, 2008 to 2014, for most people in the news to hear that the markets got above the highs of 2008. But when they looked at their statement, it was a different story. You see, their statement hadn't hit that magical number that's in their head. Even though the news said the markets were higher than where we were, their account did not reflect the same thing. And they start thinking, oh, well, maybe the news channel's talking about a different investment. Maybe we were invested in something worse. But that's what your mind does, but it's not. It's just math. You lost 30. You didn't make back 43 yet. You see, 2014 might have been the highs of the high. So sorry, my chart's not lining up, but it might take you till 2015 to make back what you lost. How many years is that, folks? 7 years of your life, 7 years of your investments, 7 years of your retirement that it took you to get back what you lost because you decided to play the long game. I'm going to invest for the long haul. I'm going to just understand this is a paper loss. We're just going to hold steady, whatever you guys want to call it. This is logic, folks. Logic. It's all I'm trying to get out. Now what I want to do is I want to play the emotional roller coaster that this 7 years took on your life. And now somebody in here or somebody earlier today in What the F said that they're retiring in 10 months. Anyone on here retiring in the next 3 years? Yes, Sharon, that's a great point to make, that, consider that the dollar won't buy what it did 10 years ago. I'm not even playing that card right now. Sure. So Aaron wants to retire in the next 3 years. Okay, we got some yeses. Tracy, yes. Jill, maybe. And we know Jill's story. Nick, how do you define retirement? Great answer, Nick. Great. Yeah. You're like, did Shauna just say yes? Yeah. 7 year short cycles, aka stock market leap year, 1, 8, 15. Yeah. Okay.
Chris's emotional roller coaster just went down when he saw Shauna retiring.
Yeah, I got nervous. Smokes. All right. So if any of you want to retire in the next 7 years, and you're trying to retire, and in your retirement, and I want to be clear, because Nick is right, how do you quantify retirement? And to me, retirement is just a fake made up thing. But retirement is really when you finally get freedom of your time back, when you can work when you want, how much you want, where you want, do what you want, travel to where you want. And all this is going to take time and money, right? We can define retirement in any way, but most people, retirement to them, because of what we've been trained to think, is the day we no longer have to work for that stupid job, right? That's what most people think. I work for the government. I no longer want to work for the government. That retirement is that day. Now, retirement, if it's just a day where you no longer have to go to work anymore, what are you going to do next? So now you've retired. Tomorrow's your retirement day. What are you going to do every day for the rest of your life? Most people, men, women, some, I'm going to golf every day. You're going to do that for 30 days. And you're going to be like, this golfing thing every day is fun, but I don't think I can do this every day. I need to do something. Then you're going to get out in the workshop and you're going to build some things. And that's going to go good for the next 6 months. And you're going to find all these little things, and you might make it 2-3 years. Anyone on here that's retired, please correct me if I'm wrong. And then all of a sudden you're going to be like, I don't have a purpose. I don't know what to do. And a couple of things is going to happen. You're going to die because you lost your purpose in life. Did you know the statistics behind when people retire, how long they make it when they lose a purpose for life? And a purpose for life isn't just golfing every single day. Well, I guess, maybe it could be. I don't know, whatever. You get the point. Like people die or they go back to work. Now, going back to work could work for somebody else. Like I know my stepmother, she went back to this bakery because she likes the people she works with. I mean, maybe that's an excuse. Maybe she really likes it. Or maybe you start your own little side hustle and you do that. It doesn't matter. But retirement is a date. That's what we've made it out to be. It's a day when we no longer have to work anymore. And that is a lie. That is the biggest lie. Well, not the biggest lie you've been taught anymore. Like a lot of big lies out there today. But that's a pretty big one, right? That's what we work on.
We should do a live poll someday. We should do a big live poll someday. That'd be a fun one.
We should. You know, a glorified beach bum, that's great. But I mean, how many days can you sit on the beach before you're crispy, just like a Krispy Kreme donut? And all of a sudden you're like, you know, I love this beach stuff, but maybe I can't be on the beach every day. You know, like workout people, like they work out nonstop 7 days a week. They're trying to hit gains, but eventually you're just like, I just need a couple of days off. I really don't want to work out anymore. Anyway, I'm going down a rabbit hole. 7 years is what you would have to give up to get back if you ride this next, because like we can go back in time and look, but here right now where you sit, yes, you've lost money, but what I can tell you, and I don't have a crystal ball, it broke. And I've been waiting for them to give me that thing back. You know, I brought it to the repair shop, but they haven't given it back. If we're logical, like that's the trajectory of where we're going. Does anyone disagree? Does anyone, and I always gotta ask, does anyone actually think the markets are gonna rebound and we're gonna soft land, the Fed's gonna do a good job and we're gonna soft land this? Is there anyone on here that thinks we're gonna do that? I mean, there's gotta be one. We've got 154 people. There's gotta be one person on here that thinks this thing is going to be okay, that the government's going to bail us out. No one thinks the government's going to bail out. No one thinks the Fed's going to just start printing more money again. I'm not just speculating, thinking that the markets are going to go down, right? We all can agree that that's the trajectory of where we're going to go. Whether it goes as far as 2008, I don't know, but it's going to go lower than where it is. Well, I don't have this, but you are welcome to do this. It's a very simple thing. You can pull up the S&P 500. And what I want you to do is I want you to pull up the S&P 500 back to 2008. And what I want you to look at is I want you to look at how that whole thing looked, okay? Because it's going to look similar to this. This ride that we've had from the pandemic straight up, and that's the wrong color, but from the pandemic straight up is literally just that. It's almost a false, it's almost like an artificial line, like that came out of like, God gave us this because it just went straight up. Which when something goes straight up, typically the other side is the same, straight down. And that's not just guessing. That actually comes down to a very important thing we all need to understand about the markets is support and resistance. And if I were to draw support and resistance, it would look kind of more like this. When a market falls, it's going to fall and it's going to hit these levels and it's going to continue to fall and it's going to hit these levels and it's going to continue to fall. Now, what that's based on is it's based on the flip side of the equation. It's based on the upside. So when the market goes up, do markets go straight up? I mean, well, I guess if from the pandemic on, yes, but they don't go straight up. They go up and then they bounce around and they bounce around like this. And then they kind of go up and then they test that and they kind of go up and they break free and they bounce around and they bounce around and they go up. Okay. But you know, how we look at it is we're just like, hey, that's what it looked like. That's kind of how we do it. See, what we're creating here is support and resistance levels. Each one of these, and this is not a very good representation, creates levels. Right now, I want all of you to do this. I want you to look down. What are you looking at? The floor of your house or whatever, your office building. Now look up. That's the ceiling. Floor, ceiling. Okay, we all got the same thing. Each one of these is how the markets work. Stocks will trade based on support and resistance. So we'll just call it, for simple sake, floors and ceilings. And typically it takes hitting a floor or a ceiling usually about 3 times, okay, before it will make its move to the next or proceed lower. Now that's complicated stuff. We don't need to know that. But when the market goes up, we have to pay attention to these different levels, because when the market goes down, it's going to go down based on those same levels. And those levels will show you kind of where we're going to go. Now, when you've got a market that went up like this with very little of those things, there was not really many with 3 touch points. When it comes down, just like we've seen, it comes down very fast because there's nowhere for it to stop. We went up so fast, it doesn't have all these different levels to stop at. Right now, the levels we're playing off of, which is where we're at right now, are the levels from the pandemic. I just want to be clear. We haven't even gone below the pandemic levels yet. That's how fast we went up. So we're playing just off those levels from the pandemic. Now, the next ride down, which we were super close. Matter of fact, I think we were on our way. The next ride down doesn't have a lot of stopping points. It's kind of like a train, last stop until New Mexico, whatever, making shit up. Okay. And you're like, whew, that's a long way. I'm like, what if I have to go to the bathroom? What if I got to do this? Maybe I don't want to go all the way to New Mexico. But that's what you got to look at. Maybe you don't want to go all the way to New Mexico, which means maybe you don't want to ride this thing all the way down. So you got to figure out, where is your point where you're going to get off, and how we're going to do that. 20, 30, 40, or 50. Okay. Does everybody understand where I'm going? I'm logically talking you through this. You, not me, you all need to decide where you want to get off the train, because you know the ramifications. And I'll just give them to you again. If you lose 20, you only got to make 25 back. No big deal. Okay. No big deal. You lose 30,
43.
Yeah, 43. We got to make 43 on the flip side. We got to go up 43. 67. Okay, if you lose 40%, and we all know the big 100, and I'm not going to go lower, but if you were to pull up a stock chart and you were to look, where are the next stopping points? I've got some bad news for you. After we get below the pandemic levels, the only solid floors and support and resistance levels where we're going to even be able to test and play come around 2014 a little bit, but not strong, really strong around 2011. Okay, the Euro crisis. There's a lot to happen during that period. That's where a lot of those strong levels are. Now, let me just pull up something here really quick. Jason, while I'm pulling this up, can you just kind of walk through some of this stuff just from what we do and how we do it with, the money multiplier and some of the money school stuff we do, on why we don't really ever care about these things that everybody else is worried about, and why our money never really seems to do anything but go up. Can you just hit a couple of those while I pull this next chart up?
I thought you were going to ask me to explain that stuff. I was like, I'm not going to be able to do this at all, Chris. When Chris was bringing that up, I was back to riding the emotional roller coaster of when I used to go into Schwab and ask them, say, hey, I'm putting in my maximum. And they'd ask me two questions. Number one, how do you feel about taking on more risk? What does that mean? And number two, they would always ask me, well, you say you want to retire at 54. How's 72 sound? What's behind door number C? There was never a door number C. So how do you take yourself and move yourself away from the market, move yourself away from people that don't have your best interest, and then tie yourself to something that from the day that you are one of the lucky ones that get the guaranteed good stuff, that you're growing day over day from the moment you fund it forever, no matter what, until you shuffle off this mortal coil, till you graduate, till you kick the bucket, till you're gone. And then you get the second guarantee. So my life's easy. I get to sit around and throw around guarantees all day long, Chris. That's how we take us away from what you just drew that brought me back to where I was in a lot of pain.
I love it. And our money never, ever stops making money, no matter what the economic cycles are. And I'm going to hit that one individual's question in a little bit about, what happens with, when insurance companies, here with negative rates and CBDC, how secure is our insurance policy? So that's Brad's question. And Brad, I will hit that. Actually, we will all hit that because we've been answering that a lot. But I just want to take you back in time. This is my best drawing, but you guys can do this. This is my best representation of really, truly what it looked like. Here's 2008. That literally, if you look at the chart, folks, that's about how fast it went down. It was severe, but it had a couple stopping points before it rested out. Post-financial crisis, S&P 500 closed at 676.53. That was on 3/9/2009. So any of you that bought on 3/9/2009, we got to talk, because obviously you knew when the market was going to hit the lowest point. So real quick, let's just do this. I want to pull up where we're at today, because it's very important that we understand where the S&P was on 3/9/2009. The S&P 500 on 3/9 was at 676. The S&P 500 right now is at 3,953.46. Okay, we were at 676.53, and 3,900 is where we're at, give or take. So then the market proceeded to go up. This was a slow go in the beginning, which it usually is going to be. You had a flash crash in 2010. That was freaky. I'll never forget that, man. We woke up and there was a flash crash. As an advisor, that really, and I was an advisor this entire cycle, just so you all know. So that's why I remember this. Flash crash, then it came back up. Then we had the sovereign debt crisis. Anyone remember the sovereign debt crisis, 2011? It was really bad. Like, we literally thought this was going to happen all over again. Everything was happening. US federal government credit rating got downgraded. And if I'm not mistaken, that was one of the first times. That was 8/5 of 2011. The US government got downgraded? dude, what is going on? But on 8/2011, Europe, remember Greece was going bankrupt and the EU was trying to figure out like, and then you saw all the debts of all those sovereign nations of Spain and everybody else. It was just like, excuse me, I'm not supposed to say that on this, but that's what we were all thinking. They're all done. Like there was like a whole chart. Like we were just like, it's done. There's no way the EU can hold this whole thing. But eventually they did. They figured it out and it bounced back. Then Obama was elected for his second term. And the S&P right here closed above 2,000 for the first time. But what I want you all to realize here, I want you to look at these levels. And if you really expanded this, you can see there's a lot of, I'm not going to draw on this, but there's a lot of support and resistance, like a lot of touch points, a lot of touch points, a lot of touch points, like a lot of support, tons of support right here before the Chinese stock market crashed and crude oil plunged in 2015 and 16. So you can see this whole thing. We were only at 2,000. That was only 2,000 on the S&P 500. And everybody was starting to feel better until this crazy mess happened. Then UK, okay, the referendum, Brexit, remember Brexit? That was 2016. Then Trump got elected, the Fed rate hike, and not to get too deep into any of this stuff. All I'm trying to say is if I were to now draw the next point of where we're at, the farthest this went, this chart was done back here, okay? This is back a while ago, but this was the pandemic. And that's exactly what it looked like. March, you can see where we fell. This is where we're at, here, right here, okay? If we turn the clock back, folks, do the math. Here, let's just do it real quick. We're at, what did I just say the S&P's at? 39.
39 something.
All right, so hold on. Let's just do some math because now we're going to get back to that mathematical, and then we're going to talk about what you can do. We're at 3,900. Now I took off 53 points. Remember 2,000. So for 39 to go down to 2,000, how much of a drop would that be? Anyone want to say 30%, 20%? 3,900 minus another 20%.
Jonathan says 15.
20%, 15%. Okay, so 15% on top of the current 20% drop brings us to that one level that I just showed of 2,000. But that was a pretty high point. And then where was it back in 2011? Probably like 1,000. So would it be safe to say if it's at 2,000 and we lose another 20, that's 1,500. So 20% off of that brings us to 1,520. And then 1,520 minus another 10%. But you guys can all see what I'm trying to show you here. How far can we go? We're down 20% right now. If we lose another 15, we're only at 2,000. You remember from the chart where 2,000 was? I doubt we're going to stop there, but we could. But that means you have lost 35%. And then if we do another 20 on top of that, so plus 20, now you've lost 55%. Do you see why I'm not making it up, folks? I'm being super real with you. 12, 16. Okay, so that would 20%. If you talk to certain economists, they say that could happen, and that would put us about 75% off. You know, that would be a 75% fall. But remember I mentioned earlier, like how far do you want to go? How low do you want to go? I can't say we're going to go 75% further down. I don't know if we're going to land at 55. I don't know if we're going to land at 35. But does it matter? Why wouldn't you just decide to go into a mode right now because of fear and lack of knowledge and not knowing what to do and just, you got to talk with wouldn't it just make sense just to logically say, you know what? I think there's some logic behind what Chris, Jason, and Joe are saying. And I think I'm just going to go to a preservation and protection model, meaning I'm going to take all of my money in my 401k, my IRAs. If you're in a self-directed IRA, you're excluded from this discussion. But I'm just talking about your regular stock investors, your 403b, your TSA, your TSP, you know, whatever you got, they go 457 plan. I don't care. I mean, they just keep going. But whatever it is, wouldn't it just make sense just to take all the money that's invested and I don't care. What if you just moved it to cash? Oh, cash is trash. Okay. Oh, I don't have a cash account. All right. Stable fund. You got one of those? No, don't got one of those. You got a money market fund? Nope. Don't have one of those. You got anything in it that says treasury? Fun. So your 401k should have a stable fund, a cash fund, maybe a money market fund, something in it that says treasury. These are all conservative. And you all know how this works, right? You go in your 401k and you got your high risk stuff, you got your medium risk, you got your low risk, and then you got your, well, some no risk. Okay. So you've got these, and then you got a whole bunch of things, internationals and all this stuff. So take all of this stuff from here and move it to low to no. Okay. There to there. I can't give you financial advice. I can't tell you what to do, But I'm just trying to kind of keep this high enough level where all of you understand what I'm talking about, and you can go back into your 401k and see what I'm talking about. And if you do this, okay, this is going to be your current assets. This just gets off the train, right? You're just getting off the train and you're just going to sit and wait for the next train. Now that next train, shit, I don't know. Last night at the airport, the Uber took an hour. It took Troy about an hour to get an Uber last night. I don't know. Maybe your next train is going to take a year. Maybe it's 6 months. Maybe it's wherever you want to get back on the train. It's up to you. But if you get off on the sidelines right now in one of these, you're protected, and then the world is yours. That's right. Now you just look at everything from the outside in. And here's the markets down here where everybody's have fear and they're losing money and you're hearing about it. Your coworkers, your friends, they're all over here and you're just staring at this. You're just like, man, that looks pretty bad. Damn, that doesn't look good.
You don't care.
You don't care. You're just looking at it and you're like, I don't know. Like, well, it's pretty bad. I wonder if I should move a little more back in. Then you decide, okay, I'm going to take 20% of my money and I'm going to put it back in because it looks pretty bad. And you just keep doing that 20, 20, 20, and you just buy back in. But here's the thing I want you to make sure you do. Whatever you're putting your money into, your new money going into your 401k, your IRA, whatever you're putting your money into investment wise, keep doing that. Like Nick's probably still buying Bitcoin, just like I'm still buying Bitcoin and Ethereum. We're dollar cost averaging. So every paycheck, when you get your paycheck, and right now, let's just say your company matches 6%. So what you're going to do is you're going to take 6% from your paycheck and you're going to put it into that 401k. This is what your match is. So you're going to put 6% of your paycheck into this. Keep this in all that high risk stuff. Keep this in that mid risk stuff. Keep this in those international. Whatever you're investing in now, keep your future contributions going exactly where they are. And some of you are probably saying, oh my God, well, why the hell would I do that if I know it's going to go down? I'm certain to lose money. You know, if that's one of you thinking that, if you keep taking your paycheck and every week this is your 401k contribution, every week you're doing this. How do you make money investing? Can anyone tell me how you make money investing? Buy and sell, buy low. Okay, that's the only answer all of you should know. How do you make money in investing? You buy low. That's the simplest answer. So if you're contributing to your 401k and the market's going down, what are you naturally doing without doing anything else? You're buying low because you're dollar cost averaging into the market as the market goes down. This is a great strategy. All of you should be doing this right now. As the market sells off and continues to go down, you should be dollar cost averaging into it. If you like Bitcoin or Ethereum, because that ride is going to continue to probably go down with the markets, well, you should continue to buy it. Any money that you've got sitting in it, why in the world would you ever want to ride that roller coaster down with your 100 or 200 or 2 million or 20 million, whatever dollar amount you've got sitting in the markets right now, like the lump sum you have, the total amount you have just sitting in the markets. Why would you logically keep your money in the markets? You already all said you think it's going to go down. So why would you? Right, Jeff, not logical. Okay, it's not logical. Okay, perfect. Todd, that's what I was looking for. Thank God. I was hoping I didn't just have to give it away. Taxes, right? What's the reason why somebody wouldn't sell their big chunk? Oh, we get to do it, Joe. We get to do it again.
Favorite.
There we go, right? Yes, tax. Jonathan's like, oh my God, yeah, tax. Let's play this out again. Here's where we're at. This was the high point. We're down 20%, but let's just say you bought down here. You're like Nick, you bought 2015. So you were 2015, you bought super low and the market's down. So if you sell, so let's just say you sell, you pay tax, I don't know, let's just say it's $100,000 gain. Can someone tell me what the taxes on $100,000 gain roughly would be? About 30 grand, right? 30,000 bucks, 30%, $30,000 taxes. Well, this is what your advisors say. Oh my God, you wouldn't want to sell. You're gonna have to pay tax. Why would you ever do that? 40,000, yeah, Todd. Well, now, so you just gave it away. We know what Todd's tax bracket is. Todd's a roller right there. 30, 40, 20, whatever it is. Like that's a lot of money to give to the government. You know, and if you don't sell, you don't have to pay the tax, right? Well, I got to tell a story. I had an investor that said that to me. That investor wanted to loan money on a deal that we had going on. We were going to pay him 12% interest. So I just all want you to remember 12% interest. This is back in the heyday when everything was going up. He was going to make 12% in this deal. He was ready to do it. And he says, oh, I just got to look at my stock. He had a highly appreciated stock portfolio with millions of dollars in gains, millions of dollars in gains. But I didn't need millions. Let's just say 500,000 is what we needed. 500,000. So can you do tax 500,000, 30%? How much money would that be? He wants to do this deal with me, but if he takes that money out of his stock portfolio, it's all taxable because it's all gains, and he's going to lose 30%. Or it's a retirement account and he's over 59.5 and he wants to take it up and he's got to pay tax on all of it. So here's the deal, folks. I got something really good. This is probably the best training. I gotta trademark this one. Anyone want to know how you or this guy could still take the money out, okay, the 500,000 in gain, but actually not have a tax gain, but have a tax loss? Anyone want to know how I showed him how to do this? You all understand what we're doing. We got somebody that wants to make an investment, but he's got all of his money in the stock market. He knows the stock market's going to go down. So he's just like, oh, I got to get it out of the market. But, oh my God, I have to pay 150,000 in taxes. Here's what we first got to figure out. On the ride up, we have to figure out where was your point where you bought. Okay. And Nick, I'm going to pick on you again, buddy, because you bought in 2015. And let's just say you bought it at, I don't know, let's just say $100 a share. I'm just making numbers up. Okay. This represents your cost basis. From tax standpoint, your cost basis means that that's what you paid for it. So anything above your cost basis is taxable. Everybody understands that. If it's in retirement accounts, here, we'll use his 400 a share. Okay. 400 a share. That's your cost basis. And that's 2015. So now if Nick were to sell that, okay, up here, I don't know, 16,000, I'm just making that up. So he paid 400 per share, and he's at 16. So yeah, so that's a $15,600 taxable gain
on one share.
On one share, and he's got more than one, right? Why would you ever sell? Nick, pay attention because this is for you too. So here's what I told the guy. I say, hey, listen, all right, I've got the solution. Here's all you need to do. This is very simple. You don't want to pay tax on this. Let me show you how to do this. What we're going to do is we're going to wait and we're just going to watch the markets. And as the markets fall and ping pong and go down and ping pong and go down, we got to pay attention because what we're looking for is at what point do we hit where the cost of the shares that we bought matches what we paid. So the market sheds, it'd be a lot, but let's just say, I'm just making a number up. Market goes down 50%. You finally hit that magic number of $400 a share because the market shed and you're down at 400 a share. Wait about another week. So now it goes down to 380. Put the sell ticket in, sell it all, get rid of it, sell it all at $380. Now here's the magic about what just happened. You'll never have to pay any taxes on any of this gain. That $15,600 that you made on those shares that you bragged to your friends about, that you made posts about, now you can say to your friends, F you, IRS, I'm not paying you taxes, because now what you got is you got yourself a tax write-off. And all you had to do is give back all the money that you made and sell at a loss. It's brilliant, right? Who said it was brilliant? Thank you, David. It is. I mean, should I trademark this? Or there's something I got to do with this, because I mean,
who wouldn't want to lose?
CPAs do not teach this. Financial advisors do not teach this, but brilliant.
You want to freak people out more? Have you ever looked at usdebtclock.org?
Oh yes, we look at that all the time. That's a frightening thing.
Yeah, 31 trillion started this year by 26.
Oh, yeah. Yeah, we should have pointed out, this is at today's tax rates, right? He'd have to pay this much in taxes, but that's at today's tax rates, which in the future we're going to be at higher tax rates. So that gentleman never lent money to me, but I bet you right now he's probably wishing that he had paid the taxes, or will be soon, because how many of you want to give all that back? It's great bragging. But really, wouldn't you have just loved to just take that money and just enjoy it and live a better life, provide a better legacy for your family, do all the things you want to do? To me, that seems like a more logical thing. So I didn't mean to waste a whole bunch of time on that. But folks, literally, do you understand what we just did? We just took you through a whole logical and emotional roller coaster ride of the markets, of where they were and where they are now, and what decisions you have to make in the future, and just some things that you could do. Just get off the train. And then some of you were it took a couple of you a little bit to get it, but you're like, oh, I can't because I got to pay taxes. Great. Then there's plan B. Just hang on to that thing until it's below what your cost basis is. But then there's still some of you, I know there is. I'm in this for the long haul. Come on. Okay. I'm in this for the long haul. Great. Okay. I'm in this for the long haul. So now it comes back up and now it's 16,000 again. I waited it out. I knew I shouldn't have sold, I don't want to pay taxes. So you waited 6 years. It's back to your 16,000 after it went down to 380. It's back to 16,000. But now tax rates have gone up 10% for each tax bracket. So now you're at 10% higher tax bracket. How about selling then?
You're still 58 and a half. So
I'm just saying, like, at what point does the rule book have to be written where like it's okay to sell and take your gains? Because for some reason, that's where most of you are struggling. You are scared to sell.
Nobody wants to pay taxes today. And what is today with taxes?
The lowest tax rate you're ever going to pay. Read the book, The Power of Zero, and I promise you that will spell it out. It's written by somebody far smarter than me when it comes to taxes. But at what point does yeah, it is a great book. I get frustrated because like these are your alternatives to me. And maybe I'm the stupid one of the bunch here, but to me, it just seems to make a whole hell of a lot more sense to get out.
Get out now.
I mean, you should have got out here, but you can't. Get out now.
And then
Dollar cost average in. You're never going to get the bottom, folks. But I don't care if you buy here, 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 or all the above.
Still make money.
You just made a hell of a lot more money. You slept a hell of a lot better during that really rough period of time we're about to go in. You got to brag to your friends when they're all saying how much money they lost and how much money they're losing and how they just lost their job and their 401k is down 40% and they don't know what they're going to do. And you're like, I know you're not going to like me after this, but I've been out of the market since January. How did you know?
You told me.
All right. So anyway, we had some fun. The Power of Now, Derek, is the name of the book. So I did way too much talking that whole first thing, but that sets the stage for the next part. The next part of what we're really going to talk about is truly like getting yourself ready for this storm that's coming mentally, the mindset that it's going to take to do that. And the easy part is although that mindset can be tough, we're all here to help you do that. We can't tell you what stocks to buy yet. It's coming to a theater near you. We'll be able to help you with all your stocks. We'll be able to give you all the advice you ever want. And what you're going to be able to do is you can keep all your money where it is in your control. And we'll just tell you all the things based on your needs and goals that you should do with your money, including, hey, I think you should buy Apple stock based on what you just told me. Yes, we're going to be able to do all that legally. SEC is going to come over and pat us on the back. They might send us a thank you card saying, wow, you guys are doing it the right way. You'll just have to stay tuned. Joe, you had something you wanted to do, didn't you?
The first thing when you get a job, what's the first thing you get? The paycheck. What's the first thing you're supposed to do with that paycheck, Chris?
You're supposed to be excited.
But you're going to put it in the bank because
Of
that's
course.
what they told you to do.
Okay, so let's write this down. So you get your paycheck and we can sum up the excited part with just a big smiley face. Like we'll get real serious here. See, when Cash gets excited, his tongue hangs out. So that's what we're doing here. So you get your paycheck, you're excited. And what's the next step you're going to do? You're going to put it in
Put
the
it
bank.
in the bank. And what does the bank do with it?
The bank makes your money work for them. It moves it.
And then, Chris, you're not smart enough to know what to do with your money. So you
course
better
not.
get a financial advisor.
Oh yeah, yeah. So we got the money in the bank, but the bank is making the bank sends that money out to work and they make a spread on that. Okay. So but we don't care about that because the bank promised, the bank gave me checks and dumb suckers. So
We'll circle back around for that.
so because I got a paycheck and I'm so excited, well, now it's time I need a financial advisor.
Jason got a dumb sucker the other day at the bank.
Yeah,
Yummy.
I haven't seen those around here. I think
Very.
in Buffalo, I think they must have done some cost cutting and they cut out the dumb suckers. Okay, so we
now
got
that you're
ourselves
not
an
smart enough
advisor.
And that advisor, you have that financial advisor, he's going to make his what, 3 or 4%?
No, that's not that much.
No, 2, 3.
1 to 1.5.
Wow.
About anyone paying more than 1.5% to their advisor right now? Yeah, Jonathan's 1.5.
But he's going to tell you to put it into mutual funds, and that's the highest rate that he's
Oh,
going to
God
get on
forbid.
commission too.
Or he might tell you to put it into an annuity. Oh God, don't even get me started. Anyway,
And then what happens when the stock market goes down? Who loses? Not
Well,
the financial
I do.
advisor. You do.
I do.
Right.
So this is how the advisor sold me though. He came up with this pretty Morningstar report, told me all these fancy things, said, hey, here's the prospectus. It's 1,200 pages long. Read the prospectus and then let me know. So I take the next year and I read the prospectus. But yeah, so the advisor puts it in and the market goes down. The advisor doesn't make less.
No. But you know what? While you're at this job, you should max out your 401k.
Oh, yeah, for sure.
We have to put
So-
every penny that you possibly can into this 401k.
Well, that's important because before the money goes to the bank, I want to get a pre-tax deduction. So what I'm going to
Absolutely.
do is I'm going to put that money over here in this 401k thing.
Because we never want to pay taxes today.
Yeah. And
We always want to kick it down the road.
I think 10% is a nice number.
Sure.
It's a nice round number. So I'm going to
Sounds
put 10% in my 401k.
Yeah.
Yep. Okay. And Joe, but hold on with this. I'm not going to pay any tax on the money that's going in there. I get a pre-tax deduction.
That's right. Not today. We don't want
Yeah.
to pay taxes.
And that really nice advisor that came out in that fancy suit told me exactly how I should invest this money. And
Exactly.
check this out, Joe. There are these really cool funds. You see, they're called target date funds. So I think I'm going to retire in 2045.
Oh,
So I didn't really know what all the funds were. And the advisor just said, hey, listen, let's just put it all in this freedom target date fund. It's a 2045. So as I get older and get closer to my retirement age,
Yep.
which my retirement age is 62,
Yep.
my 2045 fund is going to get more conservative as that time goes. Pretty
that's a
freaking cool.
that's a great
I know.
thing.
I didn't
Yeah.
even, I loved it because I was so confused looking at all those things on there. I just wanted something simple.
You know, because we're not supposed to know, like, and understand what we invest in.
Right.
So we just put our number and just pick it.
Right. And he said that's the best thing for me.
That's the way to do it. When we look at all of this, who does this all benefit? Doesn't it benefit the banks?
Well, I don't know. I mean, I guess it benefits me because I mean, I'm getting a pre-tax deduction in the 401k. I mean, the bank, I mean, they gave me a dumb sucker. Plus, like now I've got a relationship with the bank. So when I need a car loan, I don't know, but I think the bank will give me a loan for the car. And I can probably go to the bank because now that I've got a relationship and I can get a mortgage.
Mm.
And they offered me, hey, listen, they said, I got enough money in there. They offered me a CD.
Ooh.
They said that these are only
What's the
available
rate?
to premier customers like me.
Mm.
Oh, the rate?
Yeah.
Well, right now it's paying 3%
Ooh, 3%.
for 5 years. I only have to lock that money up for 5 years.
That's all?
I thought that, I didn't think that was too bad.
That's fabulous.
Yeah, I mean, 3% is way better than what they're giving me in the bank account. I mean, they're only giving me 0.00001.
One.
Is it enough? Yeah, 1.
You two are a regular Abbott and Costello. I like it.
What is this doing? This helps everybody else except
Well, no,
you,
this
really.
all helps me.
Oh, does it?
Yeah, I mean,
I
the
think this is
advisors
mindset
got my back, he's making sure my portfolio's managed. And, when we do our reviews, he's always telling me, I'm going to be fine. And 40 years from today, when I retire, like I should have enough money to retire, but I'm only when I retire, the advisors told me I shouldn't have to worry too much about taxes because I'm going to be in a lower tax bracket because I'm going to need less money when I retire. So, I mean, I thought that was great
Yeah,
advice.
Because you want to work for 50 years and not
Yeah.
have any money. I mean, that's what I strive
Yeah, that's what we all dream
No, I
about.
wanna
We
have a
dream
lot of
about
money.
working. Yeah.
He said when I retire, I'm not going to need as much money because
No.
in retirement, I mean, my gosh, you don't need
I
all
guess-
the
I
things.
guess we don't
Kids
have
are
to-
gone. I
yeah.
mean, you don't have those college tuition payments. I
You
mean,
don't have to eat.
no.
No.
No, you
well,
don't want to, you want your house to be smaller. You
Right.
Oh,
Oh, yeah,
right.
he
Oh,
did.
yeah,
He
down-
did
One
say
room
that, you're
altogether.
Probably going to
maybe have a
downsize.
Murphy bed.
Yeah.
Yeah,
No?
yeah, you're going to downsize your house.
You're
You're
gonna
probably
be
not going to
sold.
need that many cars in the household. You're only going to
Right, you
need
don't need a
one
car.
car, just one car. I
Well,
mean,
you're not going to retire
and
until you're
Larissa,
80. You can't
right,
drive at 80 anymore anyway.
yeah, that is 80. Maybe I might move it up to 30 years, but me and Larissa were only going to need to have one car. So that's going to reduce. So we're only going to need X amount of dollars. And he said, if based on if I keep doing this and he keeps managing my money that entire time,
Yeah.
I should have enough to retire with at least $30,000
Wow.
in income. I know, I thought it was pretty good.
Yeah, that's
And then
good.
he said, we're going to index it for inflation at 3%.
Mhm.
He said, that's the going rate.
Yeah.
He said, actually, I'm sorry, I'm wrong. He said it was 3.2%.
Oh, true.
Yeah. So we're going to index it for inflation. Okay. At 3.2, 30,000. And that's only going to work out to be what they call the efficient distribution. I'm only taking 4% of my portfolio. And if I only take 4%, then I'll never touch the principal of my portfolio.
Oh, that's good.
I thought that was really good
Yeah.
too.
How much did he make during this whole time?
I don't know. Well, I think he's at 1.5%. I never added it up.
Over 50 years. I mean, I'm sure that's more than 30,000.
Oh, I don't know. He never told me that.
Oh.
He just said that's his fee.
Well, how about if you do one thing and take control of your money?
How
What
do I-
happens then?
Well, I am. I mean, I put the money's in my control in the bank. I mean, this CD, I mean, it's technically my control after 5 years. And
Is it?
I mean, down here, this money and except for the money that I put into that annuity, that variable annuity, I mean, that money I can't touch for, I think it was 8 years?
You should probably put some money in your kids' college for your kids' college plan too.
Oh.
Thank you, Jason. I
Yeah.
forgot. The advisor did tell me about that. And
What's that,
Yeah.
we're going to get
429 or
there.
something?
Yeah.
Oh, we have a
mentioned
Florida
it.
prepaid, because we're in
He
Florida,
mentioned
it's a little
Oh.
different.
Yeah, you mentioned a 529. We just hadn't gotten there yet because I don't have enough
Yeah.
disposable money because I put most of my money in the 401k. And after I put money in the 401k and I locked that CD up. So that's kind of, things have been a bit tight. So,
But don't forget to pay yourself too. I mean, we're supposed to pay ourselves some savings above and beyond all this too, right? So we can have.
I'm sort of living paycheck to
now.
paycheck
I
right
don't have
now.
any more money
Yeah,
to
I'm
save.
kind of living paycheck to paycheck right now. I mean, every month, I don't know, I got a little money going into the bank that stays there. And, the banker looks out for me and calls me every once in a while and says they have a new intro CD or, they tried taking over the investment accounts and they made a good point saying that I would then bump into another level at the bank. And instead of dumb suckers, they'd be able to give me, what are those lollipops that have the gum in the middle?
Oh,
Yeah, but I told them I got cavities from that, so that really wasn't a good thing. So I just stayed with the advisor that I'm with, and I don't know, he's looking out for me. Does anyone
touch on the.
does anyone feel like
we forgot?
What?
Yes, the match. We forgot about the match.
Oh yeah.
The 401k
So
match.
if I put 10% in, I get a 3% match. That's free money.
Oh, I forgot.
And all I need to do to get this free money is I think this thing they call a vesting schedule. I just have to work for the company for 6 years. And if I put in my 6 years there, then all the money that they give me is vested. I don't know what that means, and I get to keep it.
Don't forget your cost of living increase every year, right? Like your COLA increase.
Oh yeah, I mean,
right. It's because you're always just.
My job's been really good for me. I mean, when they give me raises every year, we do an annual review, and I get like a 25 cents, a 50-cent raise.
Yeah,
But this
obviously, look how happy that picture is. You're smiling.
I got
tongues
an
out.
80-cent raise. They said it was because of inflation. They were giving everybody a higher raise, so 80 cents this year.
Don't spend it all in one spot.
I mean, folks, I know that's kind of funny. We're just role playing here, but does this sound like any of your lives? I mean, we made a few things in there, but like, did we miss anything?
Yeah, you're missing all the higher interest credit cards that takes to live that life is the next piece.
Been there, lived that, left that, love it. Great answer, Tess.
That's a great answer.
My life, Kim. Yeah.
So why don't we do one thing?
Should we actually show people what the wealthy actually do?
Let's try it.
All right. So the wealthy, do they get a paycheck? I think they do, but see, whether it's a paycheck or whether it's a 1099 self-employed income, like we got income. Yeah. So we're just gonna erase that paycheck and we're just gonna call it income.
So instead of taking that income and putting it into a conventional bank like we're told to, why don't we put it into our bank?
Okay, so we're gonna change one thing. Okay, I can do that. That seems simple. What am I gonna change?
Put it into a specially designed whole life insurance policy. Pay yourself first.
Okay, well, Dave Ramsey told me whole life is a really terrible place to put your money. So did Susie Orman. So what makes you the right person telling me?
Because he sells term. And what is term? The number one asset line on the insurance company.
That's our biggest profit line. Yeah. So we're going to change one thing, and this is where our savings goes first. But the other thing too that we should probably try to do is instead of just having one income, why don't we have a couple incomes? Should we have a 401k?
We don't need a financial advisor.
So the only way,
we got to
folks,
go in order.
And I'm going to we're not going to role play as much. The only way you should have or put money in a 401k is up to the match, which in the last example was 3%. So if your employer will give you a match, then you can put 3% of your paycheck into that. That would be okay by me. Outside of that, these are dog shit.
Chris, can I ask a serious question here?
Yeah.
Because this is this will maybe an ask us anything. Why do we have people still putting up to 3% with the match when maybe that's going to cover their taxes in the future when they're taking it out? Like,
primarily, do you want to know why I always say that, folks? This is recorded, and I guess I'm going to be really transparent, so that someday later, some asshole doesn't sue me for not saying that. And that's the only reason. I'm just being honest. The only reason you'll ever hear me tell you to put money into a 401k is because I don't want someone suing me because they didn't get their free money. And I just want to be transparent. This is the first time I've ever said that. But Jason, that's why. Because I know for a fact, if I say what I want to say sometimes, then somebody's going to sue me and say, well, you told me don't put any money in the 401k and I gave up on this. I'm suing you. And they'd probably win because they would add up how much they lost in the match, and their attorney would make a huge case of how much that changed their lifestyle and how they had to live on, mac and cheese and ramen noodles. And dude, what's wrong with ramen noodles? I mean, those are the bomb. But anyway, they had to live on ramen noodles, and they could have afforded with that match lobster and steak every day. And I'm the reason they didn't have steak and lobster every day, because I told them they should never put their money in a 401k. So I'm telling you, Put your money in a
Chris,
401k up to the match.
So it scrambled my brain, right?
I know it's true, Jeff. I know it's true. It's sick.
But what does a 401k
being
do?
honest.
You're taking money.
It doesn't matter what it does, but
you're putting it into an account that you can't touch.
yeah, you got no control over it.
But if you need it, you get penalized.
Yeah, yeah,
10% before
10%.
59 and a half.
10% IRS penalty, pre-59, unless it's a Roth, then
Yeah.
after 5 years, you can access your principal.
But if
Okay.
it's a Roth, then it's already taxed. So why we wouldn't put it in that anyway? Because
Well, we can make some points on self-directed Roth. I would say that about the only one. 10% IRS penalty, plus I'm gonna pay tax on all of this.
Yeah, and you have a silent partner that no one talks about, right? And like no one talks about the government's your partner. And as your seed that you originally planted is growing and growing and growing to harvest, they're taking more and more, but they're so nice. They've never come and said, hey, I'm your silent partner. Like you should get out now.
We do
charge you on
things
your own
with
money, that's
money
right.
that we don't do with anything else.
Yeah, we do things with money we would never
you
do
buy-
with things that money buys.
Buy a car, put it in the garage and say in 5 years, I'm gonna drive that car. Buy a
Someone on here
house,
might.
buy a house and say, I'm gonna move it into it 10 years.
Nope.
Buy a loaf of bread, stick it in the freezer. Say in 30 years, I'm gonna have a loaf of bread.
Nope.
Then why do you do it with your money?
Because that's what somebody, because that's
why
what
is
they've
that
been,
We're taught,
that's what they've been brainwashed
because it helps
to do.
everybody else. It helps the bank. It helps the financial
Yeah,
advisor.
advisor gets paid, Wall Street gets paid.
Yep.
My money's in their control now,
And
and they get to use it.
And what happens in the 401k in 30 years? If you paid taxes on it today, you're
No,
done.
I saved less in taxes than what I'm gonna pay when I take it out. And
Exactly.
that's almost a guarantee.
That's kicking
I
it
just
down
can't
the
say
road.
that because somebody will sue me if I say you're guaranteed to pay more in taxes. Because then they will intentionally at retirement, make sure they're in a lower tax bracket and see, I told you I wasn't gonna pay more in taxes. You're living in poverty, but it doesn't matter. I told you and I'm suing you.
That's my bridge.
And this all, guys, goes back to mindset, right? Like where you just went with all of this goes back to mindset and what's an abundant asset versus where we're scrimping and saving and hoping that something's going to work out because we're giving control away. Because we think we're not smart enough because no one's taught us finances. I had a conversation like that today where they saw the logic, they saw what they wanted to do, they saw what they were going to recapture, what freedom was going to give them, and the instant legacy it brought. But there was still so much fear. And it's a fear of effing up because we're so used to being taken advantage of. This is like my freshman year history teacher saying, hey, he was a veteran, right? And he would say, hey, look at this book and look at the picture and look whose point of view it's written from. This is written from the US's point of view. If you go read about this war in another country, it's going to say something different. And that lesson has always stuck with me. Like what is the person actually saying and who is actually benefiting in this scenario? And if we think about those things and own it, then that changes our whole world.
I love that. Anyone ever read the children's book, The Missing Piece by, I think it's Sal Silverton? Anyone ever read that? The Missing Piece? It's a great book, right? That little smiley face rolled around, went through everything, went over oceans, looking for the perfect piece, went on this journey, finding the piece, and on the journey had fun, talked to the worm, got to, smell the flower, got to have the butterfly land on him. And then all of a sudden he finds the piece and he puts the piece in his mouth and now he's complete. And now he can roll so fast that he doesn't have time to talk to the worm. He's rolling so fast, he can't stop and smell the flowers. He's rolling so fast that now the butterfly can't land on him. He's rolling so fast and now he's complete. So he tries to sing his song and he can no longer sing his song because he's going too fast and he's complete, that he just stops and he says, whoa, all this time, this journey, I've been looking for the missing piece. I've got the missing piece now. I'm complete. I'm fast. I'm efficient. But I gave up on everything that was important to me during that journey that I loved. Like the worm, I had great conversations with the worm and smelling the flower. Oh, it smelled so good. And that butterfly landing on me, that was the best time. You can all tell I have a 2.5-year-old Shell Silverstein. It's a great book, but it's exactly what we're talking about, right, folks? We're going through life always looking for that missing piece. Guess what that missing piece always has been? You are the missing piece. Stop trying to think that the missing piece is a 401k, you're this advisor, this fancy thing. The missing piece is you. It always has been and it always will be.
And I'm going to free everybody who's not math oriented like Chris and Joe. It is not only about the math. It is about the discipline. Like you have two pains in life, the pain of discipline, pain of regret. You pick pain of discipline, pain of regret.
Yep.
If you don't respect yourself and love yourself enough to pay yourself first, like if you're going to go to a job and be miserable, if 95 out of 100 people are miserable and they don't have enough to say, what can I do? What can I learn? How can I grow? Then that's on them. That's on out there, right? And that's nobody in this room. But that's the same thing with what we're talking about with taking ownership of your money. Just look who's getting the advantage. Are you happy? Are you getting what you want? Is this your big dream? And if not, own it. Go find what, and that's how you end up talking to us, is because you've gone down that rabbit hole. You've gone deep and you've looked at everything and you've watched all Chris's videos and all Brent and Hannah and our teammates, you know, all Devin's videos. And you say, there's truth here. Something feels real. So it is all based on emotion. No matter how someone's telling you it's about math, at the end of the day, we're making a decision. We say, I trust this person. I like this person. This person's like me. They're looking out for me because we want to belong. That's our tribal instinct.
There's only one thing holding you back, and that's yourself.
And all of you during this entire webinar that we just did, we went on a journey. We went on a journey of emotions. We went on a journey of logic and mathematics. We went on a journey of your missing piece, thinking you need this and this and this and this and this. And we're ending at one thing because we're almost finished with this webinar. We're ending at you because in this thing right here that we said you change one thing. And that one thing is where your savings goes first. And yes, is it a specially designed and engineered whole life? Yes, but that's not the missing piece. The missing piece is this. Be your own bank, your own. You are the missing piece. See, it's not the whole life, not the specially designed whole life that we design. It's not this new amazing plan that we now have created for the first in an industry with One America, where you get the high early cash flow year one and all the stability of the plans that Nelson Nash and all of us talk about in all the other years. It's not none of that. That's just a machine. It's just a thing that we put our money in and take our money and run it through. That's it. You are the missing piece. You are the thing that's lacking, and you need to learn how this works. Now, we're not here to teach you the infinite banking concept today, but the infinite banking concept, just for the record, so all of you understand, is not a product. I did a video, and I'm just going to share my screen really quick because this is very important. I did a video right here, okay? And let me get it up. This video right here on my YouTube channel, and all of you should subscribe to my YouTube channel. It's the
Pound that button, smash it.
Smash that little bell right there. See that little bell? You got to hit that thing so you're notified every time I put a video, and that is every single day. But this video teaches the infinite banking concept without a whole life insurance policy. Why? Right here. If you live outside North America, which is the US or Canada, you can't buy the whole life. Yeah, that magic missing piece, that whole life doesn't exist. But you know, people are like, oh, that sucks, I can't do it. Well, this video shows you how you can, and you don't need the whole life. Now, if you're in the US or Canada, you'd be stupid not to use the whole life to do it, because that's the only way you're ever going to allow your money to work for you while you get to use your money at the same time. But you see, we got all these videos that we spend all this time and energy putting up over and over and over again. Private money, you know, how I lost $534,000 through the infinite banking concept. Now, if you haven't watched this one, it's hilarious. I didn't lose $534,000. I gave up the equivalent of $534,000 that year in commissions so that my clients had access to more of their money. You see, that's the magic thing too. The way we design these policies makes it so we have to give it up. So all the answers to what you need may or may not be on my YouTube channel, but it gets you a lot closer to where you're at now. Should I keep my old 401k? Like the recession there's just so much stuff on there, and it's all free. You don't have to pay for it. You didn't have to pay to be here. I said this and I argued with people earlier. You know, they're like, oh, you're just doing these wealth webinars to sell that whole life. Listen, folks, we don't have to sell you the whole life. Here's the beauty. Here's the magic thing. We don't have to sell you the whole life, because here's the news. We're going to teach you what it does and what the infinite banking concept will do for your life. Like get all the money back for all the cars you ever buy, drive, and own. Pay off all your debt without working any harder, any longer by just changing one thing. Be able to have your money in a place where then you get to use it to go buy crypto, puts, calls, stocks, options, whatever you want, lend money, and make money twice. Mathematically, I've proven this over and over again. I'm almost sick of doing it, but I will continue to do it. Like all those are going to be reasons why we don't have to sell you the whole life, because you know what you're going to do? You're going to ask us if you can buy it. You just haven't learned how this works. That's the magic. Like, you don't have to come to this webinar and think you're going to get sold anything, because you're not. We're just going to teach you. And when we teach it, you learn, and you the missing piece starts to understand this and apply this in your life, I guarantee you, will ask us to buy one of those stupid, horrible piece of shit whole life policy, says Dave Ramsey and Susie Orman. You will be begging us for one of those stupid machines. Why? You started to understand it's not the product, it's the process that makes you wealthy. It's the process that gives you freedom. It's the process that changes your life, your family's life, your future family that you don't even know and won't know because you'll be long gone, changes their financial future. Don't believe me? Look at the Rockefellers. Okay, look at the Rockefellers. Why do they keep getting richer and richer? Oh, it's because they're in oil. It's because this. No, it's because their money never leaves their family because they learned how to change just one thing a long, long time ago. And every generation gets wealthier and wealthier because their money never leaves their family. And their money always works for them over and over again. Yes, they're in oil. Yes, they've done lots of things. Good, bad, indifferent, doesn't matter. But I'm just saying, they learned what we're teaching you a long time ago, and look at them go. Okay, your journey will be very different than theirs. Okay, but your journey will not start until you start to change it, until you start to reposition your 401k assets to avoid what we just clearly demonstrated is going to happen and what all of you admitted is going to happen, which is the markets are going to go lower than they are today. How much lower? Well, you be the judge of that. You already told us everything you need to tell us. Now the next step is you need to take action and do something. So Jason, I'd like to take a second and just give some time and answer these couple of questions. So anyone can answer this, Joe, if you want to. Unanimous said, so you're saying just get out of the stock market altogether, go into bonds and real estate. Is that what I said, Jason?
I didn't hear that.
I didn't hear that.
That's funny. I do get off in tangents and I do draw a lot and start talking and forget what I say, but I don't think that's what I said.
We
But
said to move it to a stable fund or a mutual.
I believe my wording was
money market.
and this isn't appropriate for everybody because I don't want you to sue me, Mr. Unanimous. So this might not be appropriate. Make sure you consult with your financial advisor, your tax professional, and your attorney before making any decisions. Actually, why don't you just go to the mirror, look in the mirror and say, am I sick of losing money yet? And then you can answer your own question. And then you can go talk to your advisor, whatever you want. But I think I said, maybe it's time to get off the train and seek preservation of your money, to seek safety of your money, to look at protecting your money. I believe those
You did say get off the train. You definitely said that, wrote that down.
Okay.
And then once it goes down, buy low.
Okay. But you're on the right train. Okay. We just got to maybe real estate is the right thing for you. Maybe treasury bonds is the right thing for you. I don't know. I don't know you, Anonymous. You don't even have a name. Dexter said, with things happening the way they are today, businesses going under, etc., they used to be 40-40-40 rule. Has that changed, or is there another plan now? So if I'm thinking about what you're talking about with the 40-40-40 rule, I actually did. Oh, here we go. 40 hours per week, 40 years of work for 40% of your income. Well, Dexter, you're more than welcome to follow that and work your whole life on the 40-40-40, but I don't know who came up with that, but I certainly wouldn't follow that.
I don't want
because I work like 60 hours a week on a bad week. Usually it's more, and I enjoy almost every one of those 60 hours, me and Cash, because I'm not working for somebody else. I'm working for me. I'm doing things, building things, changing people's lives. So if 40 hours is what it takes you to change other people's lives and solve problems, then yes, 40 is the first one. 40 years of work. If you want to work 40 years, great. I plan to work till the day I'm till the day I'm dead. So 40 years just not enough time for me to solve the problems I want to solve for other people. But if 40 years of work is all you want to do, well, great. I'll probably hear about your funeral at about 43 to 48 years, because most people, when they stop working and have no purpose, usually they don't last long. So if you want to do that, Dexter, by all means, like that's solid plan, I suppose, to fail. And for 40% of your income, now you just lost me, dude. 40% of my income? No way. No way. You see, a lot of people are like, when's enough enough? And my answer is always the same, never. There will never be a day where anybody can sit there and say, aren't you making enough money? No, because you know what? The more I make, the more I can give. And the last time I checked, there's still children that are going hungry. There's still countries where people have to walk miles just to get clean water, and it's not even clean, and they're still dying from not having clean drinking water. Imagine that. You're giving your child, your 2.5-year-old, water that you know could kill them because you have no other solutions, no other options. When we enjoy all the things we do here, I'm sorry, there's no amount of money that I could ever make that will ever make me fulfilled because there's too many other people that need help. And it takes money to make that happen. Brent always says, I've never saw a poor person put wings on a church. And there you go for that. But Dexter, to each their own. If they want to play the 40-40-40, have on at it. But that ain't my plan, and it shouldn't be yours. And Dexter, I'm just playing into it. I know who Dexter is. Dexter is awesome. That ain't his plan either.
No.
Unanimous said, for those whole life policies, yeah, those damn whole life policies, can you start small, like 75 to 100,000 value? Can you do this with a single payment? So not what we do, you can't do with a single payment. You can start really small, 10 times your age. So I'm 45, my minimum would be 450 a month. I think the way you're trying to do it is you're looking at it like life insurance. I'd urge you to watch some videos. We got a 90-minute video and a whole bunch of videos on YouTube that will teach you about the process, not the product. You're still focused on the product. And you're, I think, looking at the death benefit. There's nothing about what we do that ties into the death benefit outside of that's the amount that's required for us to build the plan that we do. And it's a nice bonus someday when we pass. So we're always building our plans around how much money you want to save. And the minimum is 10 times your age, or just add a 0 after your age. Jeffrey said,
And-
the power of
And I'd say the reason we even say that though, is because just think, if you're trying to recapture, to use that money to have a I don't know, something to buy your iPhone or to take your kids to Disney or whatever your plan is, if you're paying yourself $50 a month, it's going to take you a long time to be able to take anybody anywhere. So that's why we say 10 times your age, right? Because people wonder that too. They think, well, why are you guys taking up 10 times your age?
Kim, can you explain the quote, poor people don't put wings on churches? It's not my quote, it's Brent Kessler. So I think what he's trying to say is, when people say, when's enough, don't you make enough money? Blah, I don't want to make more money. Money's evil, all these things. He always comments, I've never seen poor people putting wings on a church. So in other words, you don't see poor people making donations to churches to put wings on the church. It's just an expression. It's basically just like having money gives you the freedom and the luxury to be able to donate more, to give more, to help more. And he just used the church. He's a very religious man, and he's just talking about putting wings on a church and donating money to the church, giving charitable contributions to different people and different organizations. So I think that's more along the lines, and you could ask Brent yourself on exactly what his definition of that is, but that would be my take. Oh, Jason, hit that one. Frank, can someone over 65 get life insurance and be their own bank?
Absolutely. Absolutely.
100%.
Not age prohibitive.
Yeah. Sharon said,
Could you maybe get to like what, 80? We say 80. I've heard Brent say.
Yeah, 75, 80 gets tricky. All right, folks. Well, I think we got through all the questions and we're a little bit over time. So this afternoon, folks, 4:30 p.m. we got Ask Me Anything. You can join us. You just got to subscribe to the YouTube channel and we'll notify you. It's a StreamYard. So you can join us on YouTube. You can join us on Facebook. We stream to all of my channels. So if you have additional questions and you just want to join us for a good time, a happy hour, kick back with a cocktail, we'll see you at 4:30. Until then, thank you all for joining us, folks. We understand this is your time and your time is priceless. So we understand, even though you didn't pay, you paid the ultimate price. And that was giving us your time. And I can't tell you how much I appreciate that. I appreciate you, Joe and Jason.
Absolutely.
Thank you all for being here. And Shauna also for helping facilitate some of the questions. Until the next time, see ya.
Bye.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them. But I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.